Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we going to talk about? Well, I'm going to continue my series on Jesse Livermore. I woke up thinking this morning, I thought I'd bang that out in a couple of weeks, but it's taking a little longer. And that's actually a good thing. There's so much wisdom from Jesse Livermore. Also, the methodology, thanks to the market improving, today notwithstanding, today is August 2nd, 2023, has really given us a lot to talk about the methodology in action. And I think that's important that we pay attention to what's happening in the market when things get active like they have been lately. With that said, we have a mystery chart follow-up, a couple of mystery chart follow-ups. We have a simple rule this week that sometimes will help you to avoid disaster, and one cardinal rule. I guess the simple rule is also a cardinal rule. Housekeeping, you do take requests. If there's something you want me to cover, please let me know. You can reach me at daylander.com/contact. My Twitter is tfollowingmoron, and my YouTube is at Dave Landry. If you want the slides from this show and all the other shows combined, you can go to daylander.com/stockcharts. Also, if you'd like to join me live, every Thursday I do a live webinar. You can bring your questions, your favorite stock picks, and I'll be happy to answer them and take a look at your stock picks. All right, let's talk about the mystery charts and the methodology in action. Here's a stock that was a mystery chart a week or so ago. And just to remind you, this one was accelerating higher in a nice uptrend. Lots of Landry light, meaning the lows above the 30. And then it had this TKO type of move, trend knockout move. So there's the parameters down below. Entry was 242. Stop was down here. IPT was up here. Now, I did gap open, so our entry was a little bit higher than what I initially suggested. And it did initially move a little bit in our favor, so we were able to bump that stop a little bit. But since, it really hasn't done much. And so far, it's been underwater for a week or so. So you might be thinking, hey, Dave, is that dead money? It's not making any money. In fact, it's actually losing a little money. And it's been about a week or so, actually almost 2 weeks since you got in it. No, it might turn out to be dead money, but I'm just going to honor my stop and see what happens. You really have to have a plan and follow it. You can't get out just because things aren't always going your way. Believe me, most of the time they won't be going your way. As I often say, as a trend follower, you spend a lot of time less wealthy. But that's okay, because occasionally you do really, really well, and that makes it all worthwhile. So we have a mystery chart this week. It was in a nice accelerated uptrend, and a nice TKO move. Also, this is a Landry light pullback. As you can see, we had about 20-something or 30-something days of Landry light, and then it pulls back to the 30 EMA. So there's the parameters down below. Entry of 350, stop of 250, and IPT of 450 on that one. So the entry is here, stop is down here, and the IPT is up here. Now here's the mystery chart reveal. This one was mentioned a couple of weeks back. Notice that it's an IPO, of course, and then it had this deep retracement, bigger picture pattern that I like to trade. The parameters are down below, as you can see. Entry was here, stop was down here, IPT up here. And this is KNF. Now, just to show you something real quick. It did make a fast move on the open and kind of barely triggered. I didn't take that initial trigger, but I did take the second trigger in here. And so far, not so good on that one, but we'll see what happens. So here's one that's still a mystery chart. As you can see, it accelerated away from its moving average, had a really nice deep pullback. And you can see the parameters down below, 135 and 265 for the entry, protective stop, and initial profit target, respectively. So that looks like that, and that, and that. And I think we actually moved the entry down a little bit to 195 on this one. Now let's take a look at what happened. The entry was up here, and notice what the stock did. It just absolutely imploded. So when I see this happen, I think, whew, no capital was put into harm's way. Now, let's suppose you entered the next open after I recommended a stock because you didn't feel like waiting for that stock to rally, and that's something that Livermore talked about quite a bit, is waiting for things to go up if you're buying them and waiting for them to go down if you're shorting them. You don't try to get a bargain when you trade. Anyway, if you would have gotten long on that open, you would be down over $2,600 and possibly counting. So as you can see, sometimes paying more for a stock is actually a good thing. And that was last week's lesson, or part of last week's lesson on Livermore. I showed this in my last week of charts, and I thought it'd be important to show it in this show too. So I'm going to show you something that a guru has never shown you. It's kind of funny, especially like if I'm in front of foreign audiences. I'll say, I'm going to show you something that nobody's ever showed you, that the guru's never showed you. And everybody gets excited. A few people actually wake up. And then I show them a losing trade. Because you know what? It, spelled with a silent SH, occasionally does happen. So here's one we got in right around here. And our stop was right there. We got stopped out for not quite a full loss, which would be a full 2% on the account, but a little bit less, as you can see. But still, 18, 18, 18, 18. You add those two together. That's actually just one trade because we split everything into twos in the spreadsheet, and that's so we could track the trending loaf and the trading loaf. Notice right here the sim trade from last week or week before. We're up 20% on the first loaf. We took $1,000, or banked $1,000, I should say, and then we're up 50% when we stopped out at $2,500. But anyway, $1,600 plus, not so great, right? It, spelled with a silent SH, again, happens. Very important to use stops. Let's say you said, well, the heck with it, I'm not going to use stops. At the low, you would have been out $6,181, and that's a lot. And that's on a 100K account, so you'd have been down over 6% on your entire account just by not following this one simple rule. He who fights and runs away lives to fight another day. So honor thy stop. By the way, if you want to see all these archives, you can go to dayline.com/archives. These are all my recommendations I make. Once I make a recommendation, and after about a week or so, I put them here in the archives, and I'll get those updated before this show posts. So you see the more recent ones. All right, let's jump back into Mind the Trade. And again, we've been talking quite a bit about Jesse Livermore. And as I say each week, I'm pulling mostly from Reminiscence of a Stock Operator. I will pull a little bit from the biography for color commentary, and then eventually a little bit from How to Trade in Stocks. And this week, we're still working on Chapter 10. I would urge you to reread Chapter 10 in Reminiscence. I say reread, I'm assuming you've already read it, but do read Reminiscence of a Stock Operator. You can go to dayline.com/books-2-read for a list of books that you should read. Anyway, when we last left off, Livermore was talking about waiting for your pitch. And he was talking about how instead of just buying a market, if you're bullish, waiting to see if it actually goes up. And what he does, and we'll get into this in just 1 minute, is he actually would scale in. If he makes a buy and then the stock goes up, he makes another buy. If it keeps going up, he keeps buying the whole way up. If he makes a buy and it goes down, then he has his smallest position and he stops out. So basically, you need to be mentally and monetarily prepared for when the next big trends come along. So instead of trying to buy while something's in a base, thinking you're getting a bargain, let it break out of the base and let everybody else fight it out when the stock is just chopping along. And that's a lesson that's coming up in future presentations. So once again, he was talking about scaling in, and basically he's saying, as I just said, wait for price to go higher. I agree with that, but then he buys a small initial amount. And the way I trade, I think it works much better if you buy the full loaf, and I'll show you why in just 1 second. Now, he also went on to say that he doesn't do any additional add-ons until the price confirms. So as I just said, if it keeps going higher, he keeps putting on more and more of his position. Now, he makes a case for establishing large position this way. What I accomplished by sticking to my system was that I always had a line of cotton in every real market. In the course of accumulating my full line, I might chip out $50,000 or $60,000 in these feeling out plays of mine. So he takes a stab, see what happens, and if the market comes back in, he gets out. This looks like a very expensive testing, but it wasn't. After the real movement started, how long would it take me to make up the $50,000 I had dropped in order to make sure that I began to load up at exactly the right time? No time at all. So his point is, let's say a market's going higher, he keeps buying, buying, buying. Then he has a huge position in a market that's going up. Now, if you are trying to establish a huge position, if you have millions and millions and millions of dollars and you want to establish this huge position in one particular stock or commodity or whatever the case may be, then yeah, maybe you should scale in because you can't just pile in anyway because you're too big. So scale in and then wait for confirmation before getting fully committed. I have no problem with that. I think if you're a little bit smaller trader, you're much better off going in at the full loaf. And then, in my case, I risk 2% of my account. So if you're risking a small percentage of your account, such as I do, 2%, and as you should, by the way, then put on 100% of your position at once. If the market proves you right, then stay with the position, take partial profits just in case, in other words, scale out, and then slowly transition to a longer-term trend follower. And as I often say, that's where the money is in the longer term trends. For instance, just recently I showed you a little trade. That's a kind of a, I wouldn't say S&G trade, but it's sort of a trade just to show the TFM 10% system in action. And I bought the Qs around 319.5, and they ran up as high as 380. Now it's pulled back a little bit since, but still 50 points or more in the trade. That's good money. Now, just getting back to the SYM example from weeks prior, again, we took half the profits, which comes out to 1K per 100K. At that point in time, the stop is brought up to break even, and then we allow that to gradually loosen up over time. Again, the real money is in the longer term trends, but you never know when they're going to come along. So we take each trade like a swing trade, and if that works out, then we slowly change hats, so to speak, to a position trader. So we got stopped out for 2,500. Ideally, you want 25,000 or 250,000 on that second loaf. In other words, stick with it as long as it moves in your favor until you're proved wrong. And then, just in case things don't work out, like they did on the second trade here, you can see it rallied up, it hit the IPT. We made $1,000, and then we made 0 per 100K once again. So that one just flat out didn't work. It happens. So again, as I often say, that's much better than a poke in the eye. Now, it's a bit of a bummer because this thing went up about 20 points on the following day, and that's a bummer, but you're better off following the rules. Remember, the market is a bad teacher. Let's say you stuck with it and it went up 20 points. The market just told you that you should always stick with positions. Unfortunately, as I just showed you, that could be a very, very, very expensive thing to do. Now, he talks about this trader who was following someone else's system. And this trader did really well as long as the system designer was alive. And then he initially did really, really well for a while at least, when this system designer passed. But then he violated his rules and then he went broke. He came back once again, he tried the system again, and then he made $15,000 but went broke yet again by not using stops as the system suggested. And then Livermore went on to say, he borrowed $10 from me for a baby carriage, his fourth. He did not stick to his own proved system. That's the trouble with most of them. Most of the traders cannot follow a system. And he was right. I sometimes think that speculation must be in a natural sort of business. It is. Because I find that the average speculator has arrayed against him his own nature. The weaknesses that all men are prone to are fatal to success in speculation. Usually those very weaknesses that make him likable to his fellows, or that he himself particularly guards against in those other ventures of his where they are not nearly so dangerous as when he is trading in stocks or commodities. And in prior presentations, I talked about Livermore discussing someone who would throw around money in the market like it was no big deal what he would pay for, according to Livermore, a medium-priced automobile. But in real life, he would no way act in such a way. I have a friend that's a little bit on the frugal side, and I guess he's just very prudent in life and doesn't really throw a lot of money around in life and saves his money, etc. But in the markets, he's willing to just fritter it away without a care. So for some reason, trading sort of throws a lot of these behaviors out the window. The biggest takeaway from this book is that the speculator's chief enemies are always boring from within. Amen. And what he's saying there is trading psychology is vitally important. You can have the best system in the world, but if you're not going to follow it, it's not going to do you any good. And this is why I spend so much time talking about trading psychology. It is inseparable from human nature to hope and to fear. We all hope, we all fear, right? Now, Livermore goes on to say you should hope when you should fear, and fear when you should hope. When the market goes against you, you hope that every day will be the last day. You lose more and more than you should had you not listened to hope. So in other words, honor your stop. Tom McClellan once told me something funny, and I wish I could remember exactly how it goes. And basically he says that his drill sergeant, or it might have been one of the commanders, told him that hope, as in birth control, is not a strategy for warfare. So I think that also dovetails nicely into trading. Now, with fear, when the market goes your way, you become fearful that the next day will take away your profit and you get out too soon. So that's Livermore's words. Now, if you read these two things and think about it, it's kind of like the old commodity adage, eat like a bird and defecate like an elephant. That means that you're taking little bitty gains, but you're taking huge losses. And that's a great way to lose a lot of money. So if you hope when it comes to losses, you're going to lose too much because you're going to keep hoping that you're not going to lose any more. And unfortunately, hope, again, is not a strategy. And then with fear, it's like you're taking profits because you're worried that they're going to evaporate. You'll never make enough if you do that. Again, the old commodity adage comes to mind. So Livermore went on to say that you should hope when you should fear, and fear when you should hope. So if you have losses, you must fear that they get bigger and stop yourself out. And if you have profits, you should hope that they continue and let them ride. He, the successful trader, has to reverse what you might call his natural impulses. Instead of hoping, he must fear. Instead of fearing, he must hope. And again, he must fear that his loss may develop into a much bigger loss and hope that his profit may become a big profit. So said alternatively, cut thy losses short and let thy profits ride. So with hope, you want to hope that your profits, again, continue to grow, and then you want to fear that your losses will grow and obviously do something about it. A lot of times with hope, with the profits, there's nothing to do. So again, hope to fear and fear to hope. Now Livermore wraps up the chapter by saying, I have been in a speculative game ever since I was 14. It's all I've ever done. I think I know what I'm talking about. And the conclusion that I have reached after nearly 30 years of constant trading, both on a shoestring and with millions of dollars back of me, it is, a man may beat a stock or a group at a certain time, but no man living can beat the stock market. A man may make money out of the individual deals in cotton or grain, but no man can beat the cotton market or the grain market. It's like at the track. A man may beat a horse, but he cannot beat horse racing. This reminds me of when I was talking with Bruce Frazier back at ChartCon last October, and he told me that his family was in the horse racing business, not actually betting on horses, but more of the pick and shovels, and they supply the gates and other equipment. And he said that a good handicapper will only make a couple of bets a week, and the rest of the time he's just studying the horses. So a good handicapper can't really beat the track, but he can make money through horse racing by picking his spots carefully. So what Livermore is saying that you can't always beat the market, but if you pick your spots carefully and do the things like he talked about by buying only when things go higher, then you can occasionally make money in an individual stock or other markets. Well, that's all my time for this week. I want to thank everybody for watching. Again, there's all the information for if you need to reach me or if you want some follow-up information. Go to davelandry.com/.